Hey guys, welcome to the Untapped Wealth channel. This might be one of the most important videos that you watch about your retirement and financial planning. By the end of this video, I'm going to show you why using rate of return as the method to evaluate your financial and retirement plan is incomplete at best. And I'm going to teach you a more complete, better method that will drastically change the way you view preparing for your future. I'm Matt Kennedy, the founder of Kennedy Wealth Design and the author of the best-selling book, Untapped Wealth. We created this channel to help high-income professionals, business owners, and entrepreneurs really have a better method of managing and preparing for their future so that they can have a better life now and a better future tomorrow. For financial advice that goes beyond the typical approach, be sure to subscribe to my channel and make sure you click on the notification bell so that you'll be notified when I post new videos. Well, let's face it, financial assets and a financial plan is very hard to measure. And so when we consider what an investment is worth or whether or not it's a good investment or not, we often turn to rate of return. This can be very short-sighted for several reasons. First, when it comes to finding the value of something, it's only worth what it can be traded for. And the environment that we are in really impacts what we're willing to trade to get certain benefits. Let me give you an example of what I'm talking about. When I'm in the airport, I really don't think twice about paying $4 or $5 for a bottle of water. I would never pay that outside of the airport, but when I'm in the airport or if I'm at Disney World or somewhere like that, I pay $4 or $5, number one, because I'm thirsty, and I know that that water will quench my thirst. But secondly, I know that I'm in an environment where that's just what I have to pay. I would have to leave the airport and try to get back in and go back through security, or I would have to, leave Disneyland and pay to get back in to go get a $1 water outside of Disneyland. So I'm willing to give up more for the trade. I'm willing to pay more for the trade to get the benefits of the water based on the environment that I'm in. Meaning that water has more value to me and I'm willing to pay more for it while I'm inside the airport or while I'm in Disneyland. Second, benefits can only be expressed in terms of dollars because I can only spend dollars. I can't spend rate of return. And so the focus on what's the rate of return, asking that question, is really a distraction. Let me give you another example. There was a major financial institution that did some marketing and advertising several years ago, and they had some commercials where they had people walking through their daily lives, through the city, walking down the sidewalk, into restaurants, into their place of work, and they had a number floating above their head, $1,765,000, something like that. And the financial institution was asking the question, what's your number? Meaning, what's your number that you need to retire? When I saw that commercial, I thought, wow, that's really short-sighted because there's so many environmental variables that need to be accounted for in that equation. Because when you come to the end of your life, which will be most important to you? The rate of return that you earned on your portfolio or the dollars that were available for you to spend? Go to the comment section right now and leave me a comment about which is most important to you, rate of return or dollars that were available to spend. Be sure to check out my other video titled Tax-Free or Tax-Exempt to learn more about how the environment that your money is stored in drastically impacts your future. Now, I want to introduce you to a new term, define it, and then show you an example of why it is valuable to know and to apply. And the term is the capital equivalent value. Now, this was introduced to me by Brian Bloom, a CPA, in his book series, Confessions of a CPA. And what he defined capital equivalent value as is the sum of money a financial asset would have to grow to in order to provide the same benefit of another financial asset. So as we already said, rate of return is a bit of a distracting method to evaluate the value of an asset. In my opinion, using this capital equivalent value instead of just rate of return is a much more accurate and clear method of evaluation of the value of an asset. Now, I believe a properly funded and designed life insurance policy is a foundational asset because of the 12 benefits it provides that I'll cover in another video. But when designed properly, I believe that life insurance has an advantage, and I call it wealth advantaged life insurance in my book, Untapped Wealth, or WALL-E for short. For this video, I want to use it to find its value compared to a typical example retirement account. In other words, we want to find the capital equivalent value of the life insurance. Now, there's two reasons that I believe WALL-E is unique for the purposes of this video. I want to focus on these two reasons. The first is life insurance policies come with a built-in line of credit against the cash value, meaning that the insurance company will loan you their money and hold your money as collateral. Now, what that means and why this is powerful to understand is that your money continues to earn interest on the entire balance as if no loan was taken. Second reason I believe WALL-E is unique is because the Internal Revenue Code section 72E says that those loans, this line of credit against your cash value, are considered a transfer of capital and not income, and therefore are tax exempt. We have our capital equivalent value calculator, and we're going to look at a 55-year-old who's going to contribute $100,000 a year to a retirement account over the next 10 years or to age 65, so that the total contributions are $100,000. Now, on the retirement account, we're going to use a 4% withdrawal rate, which is very commonly used. Lots of studies have said that if you take 4% off of the balance that you accumulate in your retirement account, that you should be okay if you have the right mix of stocks and bonds, et cetera. So we're just going to use 4% withdrawal rate to compare to. And then when we completed an illustration with the life insurance company, it told us that given these parameters, that the life insurance could easily support a $100,000 tax exempt income from age 65 to age 85. Now, let's compare and find the capital equivalent value to that $100,000. Now, remember that $100,000, can't drive this point home enough, that $100,000 of life insurance income is created by never spending your money, but by spending the insurance company's money and using your money as collateral. Therefore, what that means is that your entire balance is what you continue to earn interest on as if the loans were never made. So income from the life insurance at age 65, if it's $100,000, then that means that the capital equivalent value needed to match that life insurance income using a 4% withdrawal rate is $2.5 million. What we mean here is that your $100,000 invested in your retirement account every year over 10 years would have to grow to $2.5 million. In order to do that, you would have to earn 19% every year on those $100,000 a year contributions in order to match the life insurance income. Now, if that retirement account is in a taxable account or maybe a 401k, which is tax deferred, meaning it's never been taxed before, every dollar you pull out of that account is taxable. And so if you're in a 30% tax bracket, you would have to pull out $142,000, pay the tax to get your $100,000 of income to match the life insurance income. So the taxable capital equivalent value needed to match the life insurance now went from 2.5 million to 3.5 million, which means your annual return that you would have to have every year with no down years on your contributions would be 26% to match what the life insurance can produce. So this capital equivalent value, in my opinion, is a much better way to evaluate the value of an asset. And so many times, let's take it back to where we just started this, to where we started this video. Many times, so many folks are focused on the balance of your account. What can I grow my account to? And they believe that they need to have a big account balance. But what we just proved here is that we don't need a big account balance. We just need a big cash flow. So the capital equivalent value, in my opinion, is a much better, much more truthful way to value an asset. Rate of return is distracting. Capital equivalent value tells much more of the truth. Capital equivalent value is what teaches us that we don't need a big account balance. In fact, the biggest account balance doesn't always win. What we really want is a big cash flow. Listen, if you like this video, please give us a thumbs up, send it out to your friends, and as always, subscribe to our channel and click on the notification bell so that you'll be notified when we post new videos.